Hello, I'm Liz Lumley of Finextra, and today I'm speaking to Subin Paul of Oracle, and we're going to have a discussion about risk. Now, Subin, most banks employ a chief risk officer to look at risk from an end-to-end enterprise point of view, yet there's a lot of industry research that points to that a significant minority of risk officers at banks feel that they're working with effective enterprise-wide risk management systems. So, why is the industry still finding it difficult to get a handle on this true view of risk inside banks?
Well, quantifying risk is not an exact science. There are a lot of assumptions, there are a lot of approximations, there are a lot of estimates that you tend to work with. So there is that level of impreciseness in there. It's compounded by the fact that the underlying information that tends to need to be very accurate is most often not. So that is a contributory factor. But then you think about risk again, and if you are saying enterprise risk, this covers a whole gamut of areas. So there is liquidity risk and credit risk and operational risk and reputational risk and increasingly legal risk, as we're seeing in the market today. And a lot of these things require multiple things to fall in place very accurately. So this is about provisions and valuations and doing other stochastic analysis on trading book and banking book, whether these assets are on balance sheet or off balance sheet, whether they are securitized or non-securitized, and there is a lot of interplay. So unless there is a platform which allows you to contribute across multiple areas of expertise and opinion within the organization, this is certainly not going to be feasible. So all of this still is within an organization. So these are all intra-organizational issues. Now think of the resolution agencies and the recovery agencies who need to think about the entire ecosystem. So those activities between institutions, the systemic risks involved, and the contagion. So there are more fundamental issues. So it's not really clear as to how you'll identify legal entities, for example. So that aspect, as a broad example, legal entity identification itself compounds this when it comes to a system-wide risk analysis. So it's not very surprising that estimates of risk, because of the subjectivity that is involved and the other complications, is not ever entirely accurate.
So you mentioned data, and of course you talked about identifiers, and we are living in the age of big data where it's very easy to access all of this data. But what challenges do banks face in using this type of data in an intelligent manner?
So there is a tendency possibly to see big data as more of a tooling issue, a kind of a mechanism to keep up with the Joneses. That probably is not the right way to go for financial institutions, because there has to be both a realization and an acknowledgement that this is only supplementary or complementary to what you regularly do. The fundamental pieces of information need to be structured, need to be accurate, and of very, very good quality for the additional pieces to really work. So there in itself. Now, it also needs to be strictly enforced that whatever you do with this tons of data that you can grab and process and put to good use is structured towards an end goal. So if you have an end goal that I'm trying to retain customers, or I'm trying to understand customer mood or analyst mood, I'm trying to prevent acts of fraud or enforce compliance, or even more quantitative bits, like I'm trying to get a whole bunch of information that will help me estimate bond prices based on default correlations, etc. Whatever be the use case, one or more, a set of finite use cases need to be set as the target. And I think finally there is this impression that this is a panacea for a lot of ills, which it really is not. I mean, it can work under very controlled circumstances, but just because you have the ability to gather a whole lot of unstructured data and process that doesn't really cure the ills that you already have. Those ills have to be cured in a very structured, thoughtful, target-oriented way for big data and similar analysis to really work and give you benefits.
So the press is awash with stories of huge fines being handed down to banks for poor risk management practices. But can you give us some rundown of what type of cost savings banks might be able to enjoy when they comply with risk in an effective manner?
Sure. So there are clients of ours. This is one particular client who went on a journey of managing deficiencies and failures in people, processes, and systems, working through their operational risk processes. And we have it on record that it's giving them a savings of about €500 million, which is quite substantial. And this is, of course, a globally active, top-tier, systemically important institution. So when they see this as a mechanism to save costs and not just go through the motions to tick a compliance box, it has given them that level of savings, which is a substantial level of savings. And there are other cases, again, from our own clients, where the return on investment, basically by making sure that data flows and the quality of that data that flows and the timeliness of that information when it is tied up, the return on investment has been about 200%. But again, on the flip side, some of the activities like the move from the ECB, the European Central Bank, for asset quality reviews and similar mechanisms before European SIFIs go to a single supervisory mechanism. So that process has yielded results that say that even among the most diligently run institutions with very, very crisp risk management practice, there is potentially a shortfall of about 4 percentage points in the capital adequacy numbers. So identifying that, going through this process by itself, is showing up the deficiencies and the defects and potentially enabling them to save that 4% of shortfall and having to recapitalize and similar. So there are substantial savings, not just in not being fined, and these fines have been really, really large in a number of cases, but not just there, but in real cost savings as well.